Good day, Junior Tickies. I'm Mrs. Brimacombe. We are now going to look at Paper 2, Question 4. This question consists out of inventories and fixed assets. So we're going to first focus in this video on inventories, and then our second video will focus on the fixed assets. Inventories 4.1. Justine Footwear Pty Limited sells one brand of running shoes. The business uses the weighted average method to value these shoes. The periodic system, inventory system, is used. A reminder before we start with the questions. There are different ways in which we can evaluate our stock within a periodic inventory system, and another type of system that we use is the perpetual or the continuous inventory system. So we can evaluate our stock using either weighted average, specific identification, or FIFO. Sometimes they can ask all of those or 2 out of the 3 in a question. It depends from one question to another. In this question, they've only focused on the weighted average, and they ask us to calculate the value of the closing stock and the stock turnover rate. So if we look at what has been given to us, they provided information A, the balances in the beginning of the accounting period and the end of the accounting period. Take note that the total value of our closing stock at the end of the accounting period is a question mark because we need to calculate it. Purchases during the year, carriage on purchases, returns, and sales. Always read through the information before you just start with the questions. If we look at the carriage on purchase, a fixed cost of 25 Rand per unit is paid for each pair of running shoes delivered to a shop. This rate was unchanged during the financial year. This is not included above, which means that we need to calculate the carriage on purchase. If we look at our returns, 60 pairs of running shoes were returned from the September purchases specifically. So when we're looking at a refund of the cost price was received from the supplier, the carriage on purchases was not refunded. So that refund, we need to look at what was the purchases in September, what was the cost price per item, and that will form part of our calculation for returns. So to calculate now the value of our closing stock, I'm going to start by calculating the carriage on purchase. I know that 2,490 items were purchased. The carriage was fixed at 25 Rand per unit, so take 2,490 times 25. To work out my returns, 60 pairs of running shoes were returned from the September 2020 purchases. This means that the cost was 900 times 60 is 54,000. Now I'm going to go ahead and calculate the average price. To calculate your average price, you have to take your opening stock plus net purchases. In other words, purchases minus returns, plus any additional costs. In this question, there were not additional costs like custom duties, import duties. Divided by the number of units equals my average price. Once we've got the average price, we need to times that by the number of units left over at the end of the accounting period. So opening stock was given to us, plus purchases, plus carriage on purchase, which we've calculated, minus returns, which we've already calculated. We need to divide that by our opening stock plus the number of items minus 6 items that were returned. That equals my weighted average price, 890. Now we can times it by the number of units left over, and that is the value of my closing stock. To calculate the stock turnover rate, a formula sheet is given to you, but you still need to know, because the heading isn't given there, how do we actually calculate the stock turnover rate? It is your cost of sales divided by the average stock. Average is always beginning plus end divided by 2. So we've got 2 different ways in which we can get to the answer. One is by using the units. To look at the units, we're going to look at sales. The number of units that we sold was 2,216. So 2,216 divided by the opening stock plus the closing stock divided by 2, so we're going to times it by a half, equals 7,1 times. If you're using the amounts, it means that I first need to calculate the cost of sales. To calculate the cost of sales, it is your opening stock plus purchases plus carriage on purchase minus the closing stock. So I can use the figure which I've calculated in 4.1.1, and we're going to subtract the closing stock that we've calculated also in 4.1.1, divided by the opening stock, the amount, plus the closing stock which we've calculated, and then we have to divide it by 2, so we times it by 100. Take note that my answer is 8,3 times, so it's slightly different if I'm using amounts compared to the units. 4.1.3. Justine Pty Limited trades in 3 types of footwear. The table below indicates the overall performance for the year. The directors are satisfied with the management of running shoes, but not with the boots and sandals. The boots are imported and we are the only business in town selling these boots. The sandals are locally made and all competitors sell them at 480 each. Comment on the stock turnover rate for boots and sandals and identify the major problem relating to each product. Quote figures. So number 1, it's important you should eliminate running shoes. They've only asked you to look at boots and sandals. They are happy with the way things are being managed with regards to running shoes. So the focus is on boots and sandals. So I'm going to start by looking at the stock turnover rate. If we look at the stock turnover rate, boots is 2 times, which means on average it's 6 months, compared to the sandals, which is 76 times. Now, if you take 365 days in a year, divided by 76, it equals 4,8 days. So between the two, boots are experiencing slow sales compared to the sandals that are experiencing good sales. If we now compare the markup percentage, boots, they've got a very high markup percentage, 80%. This may be too expensive for customers, hence the slow sales. Remember, if you look at the stock turnover rate, it's 2 times per year. So on average, we're keeping the stock for 6 months. If we look at sandals, their markup percentage is 33,1%. Hence, This is more affordable to customers. That's why they're experiencing better sales. Looking now at the stock on hand for boots and for sandals. If we look at items on hand, they've got 440 pairs left over compared to 150 pairs of sandals. The value of the closing stock for boots is much higher compared to sandals. If we look at running shoes, in total, we've calculated in the previous question what is the value of the closing stock. Now, there's a reason why we are including this total now. If we look at percentage-wise, boots is 62.3% of the total value of the closing stock. Whereas sandals, if we look at percentage, it's only 4.8%. How do we calculate that percentage? We add all of that, and then we say boots divided by the total value of the closing stock. And if we want percentage, it's always times 100. This means that too much money is tied up in stock if we look at our boots, compared to sandals where it's much less. Now we can look at orders received from customers. Remember, when you get this type of question, there's a reason why they presented you with that information. It means that you will need to use it. Now, looking at the orders received from customers, if we look at boots, 870 pairs were ordered by customers, and our sales was equal to 870. Compared to, if we look at our sandals, 15,000 pairs were ordered by customers. Our sales was 11,400, and we only have 150 left over. This means that we do not have enough stock. We were not able to meet the demand of the customers. There's a difference if you take 15,000 minus 11,400. There's a difference of 3,600. Now, if you look at that, how much that in revenue can cost you, 3,600 pairs, which is not given to customers, which customers has ordered, and we times that by the selling price, it means that equals 1,728,000 lost in revenue, which is a lot. We can end up losing customers to our competitors if we don't have enough stock. So this is a concern. So we've now looked at identifying potential problems and looking at specifically the stock turnover rate, which the question asks. So on your answer booklet, you would see that there's comment on the stock holding rate and a major problem. So if we look at boots, remember to quote figures. The stock turnover rate is 2, average every 6 months, experiencing slow sales, generating good gross profit. If you looked at the information given, the markup percentage of 80% may be too high, expensive for customers. If we look at sandals, stock turnover rate is 76. Low markup percentage makes this very affordable. If we're looking at the major problems, too much stock on hand, 62% of total closing stock, money tied up in stock. This will impact on liquidity. Also, a security risk that stock can get stolen and can become obsolete. If we're looking at our sandals, the business is not meeting the orders, 3,600 not supplied, not enough stock to meet the orders, may run out of stock. There was only 150 left over. Loss of revenue, this can negatively impact the liquidity. This concludes inventory. So in the next part of our video, we are going to look at fixed assets. Have a wonderful day.